I'm going to talk to you about how the actions that the Federal Reserve is taking are going to bring the house down. Out of the 7 times the Fed has done this, it has resulted in a deep recession 6 of the 7 times. Can the market lose 80% of its value? Absolutely. And will they? If the Fed does what they say they're going to do? Yep. I'm your host, Chris Naugle, and welcome back to the Money School podcast. Today, I'm going to talk to you about how the actions that the Federal Reserve is taking are going to bring the house down. What do you mean the house? What I mean is the markets, the stock market, the entire economy. They're going to bring it to its knees. And this isn't the first time the Fed has done this, but it is certainly going to be probably the first time you are going to feel the pain from it. So let's dive into the Fed's trifecta and why that's going to destroy Wall Street and everything we have taken for granted, and that is called greed. Today's episode, I want to make sure that I cover what the Fed is doing right now, and I want to talk about why the Fed's actions are going to absolutely decimate the stock market. The reason I wanted to do this episode is it's such a vital thing for what's going on in the economy, because what we've all been witnessing is the longest bull run in history. Since 2008, the markets have rebounded from the Great Recession and gone straight up. And it's been the longest bull run because typically we have to look at the cycles of the markets. And the cycles of the markets are a couple different things. Number one, to make up the economy, you've got productivity. You, me, everybody else going to work, producing a product. The harder we work, the more production that happens, the more products that get produced, and the more the productivity growth grows. Since COVID, the productivity of a worker or an employee or whatever you want to call it has declined significantly. I feel like COVID gave us the perfect reason to not want to work. And the government and the Federal Reserve use this, like they have in other periods of time, use this as a reason to turn on the printing press, to approve executive orders, and to print out over $5.1 trillion. Now, depending on what you're reading and what you're studying, that's between 60 and 80% of all the money in circulation today that they printed in that short little period of time. And since the Great Recession, when they really turned the printing press on back in 2008 to save the entire financial system, which was very needed, because without the Fed printing money, and the Fed doesn't print money, but the Fed controls the money supply, and then the Treasury prints money, but the Fed then trades that money with the US government for stimulus checks, and they embed a lot of that money into the markets through the purchasing of bonds. This happened in 2008, 9, 10. They did a massive bond buying program to pump a ton of money into the markets. Then what they did is they lowered interest rates down to close to zero to stimulate people to want to go out and borrow and spend money. And that's how you get the engine working again. That's how you get the economy going. Fiscal and monetary policy. You print a bunch of money. You bring interest rates down. It's always the first lever that they pull when the markets are coming down and when a recession is imminent. They drop that lever, interest rates down to zero. They print a whole bunch of money. They exchange it with the US government, and that then pumps a ton of money into the capital markets through the central banks and also Wall Street. Real estate prices go up, and you've seen this. You've been part of this entire thing. When COVID came, that gave them the ability to then turn the printing press on again to the tune of 5.1 trillion, which makes it over $8 trillion that they have printed since 2008. Welcome to the longest bull run in history. And that's the reason why. The Fed, who controls monetary policy to a certain extent, but they definitely control the flow of money and they control the dollar. Let's never forget that the Fed's number one job is the dollar. Protect the US dollar under all accounts. That's the Fed's number one job. So let's get into this. This stuff sounds kind of boring, but it's the most important thing if and only if you care about your money. You care about your retirement. You care about your family's financial future. And if you check the box on any one of those, then sit down, shut up, and listen, because this right here will be an important message and an important milestone for you to start taking some action to protect against what is already happening, but what certainly will happen in the near future. And I'll give you a couple pointers about how you can protect that. But before we get into all of this, I want to give you something, because you know what? It's not about the knowledge you're going to learn today, because knowledge is not really power. It's something that we love to say, oh, I've got knowledge. Oh, I'm watching this to learn. But learning and knowledge means nothing without application. So many of you will listen to this. Maybe you'll do some additional due diligence. Check out my YouTube channel. I've got great videos that go deep into this. And that channel is at the Chris Naugle. Subscribe to my YouTube channel. Click the alerts button. We're putting new videos out several times a week, all about what you need to do to protect your money, not their money, your money. The other thing I like to do is I like to test every one of you to see if you actually know how to take action. So I like giving something away for free. So for any of you watching this, I've got 3 books here: The Private Money Guide, Mapping Out the Millionaire Mystery, and Drifting Away from Traditional Car Buying. My 3 books that are out right now. You can have them all for free. You can get the ebook totally free, or you can get the physical book shipped to your house. Just pay the shipping and handling. So by offering these books for free, I'm now giving you an opportunity to actually take action on an offer. Now, you've been offered things throughout your entire life, but very few of them are free. So all you do is you go to chrisnaugle.com, one index finger swipe, and there you go. You can get the books for free. So take action. And now let's dive into the knowledge that you then, after this, will have to take action on. So if we look at history and we go all the way back, you can go back to, 1913s, you can go back to the Roman Empire. It all is the same. The markets have always worked on cyclical patterns. So I was talking to you a little bit about productivity growth, which is the natural occurring growth from us going out and doing what we do, which is called produce, create. We make products, we produce things, we create a service or something that solves somebody else's problem. And in doing that, you create productivity. And the productivity line is almost just like a straight line up. It's not straight up, but it's just a nice gradual flowing line. But you see, the government and the Fed have then added a couple things, and that is called debt. Debt comes in the form of printing money and exchanging that printed money that the Treasury prints to the US government and other countries in exchange for US debt. That's how it works. Money gets printed, Fed controls how much, then they exchange it to the US government, because a lot of you think that the Fed is owned by the government. Oh, no. The Fed is owned by, who knows, the wealthiest bankers in the world. Many would say it's the Rockefellers, the Rothschilds. I say it's Satan, but hey, that's just my opinion. Read a book called The Creature from Jekyll Island. You'll learn quite a bit about the Fed, its creation, and what it is doing today. And then many of you after that will say, well, you need to abolish the Fed. Good luck, because they control the dollar. But if you look back in history, you will see that there are 2 other cycles that we need to pay very close attention to. Number one, there is the short-term debt cycle. Because remember, I said it's all about debt. Printing money creates debt and inflation, but we'll get there later. So when they print money, they create debt, which creates cycles, short-term debt cycles. Those short-term debt cycles work in 5 to 7 year stints or timeframes. And you can see this if you just go back and you go to any recessionary period and you count to the next one. Always, it's 5 to 7 years, except for this one. Because the government and the Fed have adopted a new economic theory called the modern monetary theory, which basically says that we're just going to print money every time the markets get weak. And in printing money, we can control the outcome and prevent future recessions. Doesn't work. You know what it does? It kicks the can down. It's great if you're trying to get elected. It's great for politicians. It's great for a lot of things. The Fed loves it because the Fed loves printing money because they have an unlimited supply of it. And then the debt does what? Pays them interest. Because every time the Fed trades money, dollars, for debt, they get paid an interest rate. Always. The US government pays interest on Treasury bonds. Just look it up. 10-year, 30-year, 2-year, 5-year, any duration you want, you can buy debt from the US government in the form of a bond, and that bond will pay you a coupon, which is interest. So the Fed gets paid interest. They love it. So the short-term debt cycle is an important one to look at, but if you really look at where we're at today, 2022, this is actually May of 2022, you will see if you counted from 2008 till now, we are way past the 5 to 7 year cycle. So some would say we're due. Others would say, oh, nope. The government, through modern monetary theory, has found a way to fix the problem of the short-term debt cycle. Not too fast. They haven't fixed anything. They've kicked the can. They've gotten a lot of votes. They've gotten people elected because they know how to move the needle. Good for them. You know who holds the weight of that? We do, the taxpayers. Because all that debt that they incur, all that money that's printed by the Fed, guess who pays all that back? We do, through taxes. You already know that. But some of you are like, well, my taxes aren't going up. You know, this president said my taxes aren't going up. I make less than 400,000 or it's 250, whatever number you're actually looking at. It's 400. And if you make less than that, your taxes aren't going to go up. Really? Well, I'd love you to explain to me then why a hidden tax that many call inflation, but it is just a hidden tax, has hurt your pocketbook because bread's gone up, milk has gone up, but it actually hasn't gone up. You know, the price of things hasn't really gone up. You know what has happened? When they printed money, they took away your purchasing power of the dollars you hold. You see, when they print a dollar, it takes value from your current dollar. It's called inflation. Your purchasing power goes down. The purchasing power of $1 drops every time they print a dollar. It's an inflationary process. They love it. You hate it. Gas is pretty expensive. Hell, groceries are through the roof. I don't know how many Americans are affording just to eat right now. Welcome to inflation. It's over 8.5%. And that directly, I don't give a crap what the president says, that directly is a result of the modern monetary theory of economics that they are using. When they print that much money, that fast, it is inflationary. And because they did it so fast, they pumped so much of it into the capital markets. And because of the shutdown and the demand that created, now all of a sudden you have massive runaway inflation. But that there in itself doesn't lie the problem as to why the Fed's actions are going to bring the whole house down. So let's get into the brass tacks, and I'm going to do this quick. So pay attention, take notes. And if you're still not convinced after this podcast, go watch some of my videos on YouTube, watch Ray Dalio's videos, or any economist or any hedge fund manager you want. We're all saying the same thing. So the first thing that happens after they print a whole bunch of money and they drive a whole bunch of inflation lands us to right here, right now, May 2022. Inflation at, I think right now it's 8.3% and probably will go higher. So when inflation starts getting out of control and there's more demand than there is supply because of shutdowns of China, shipping and trade is all at a halt and lots of other things, but there's still demand because there's lots of money and everybody feels rich and they can borrow money cheap. So what is it that the Fed does when they want to slow the machine down? We already know this. They announced at the beginning of the year that they were going to start raising interest rates. Well, how many times? Well, how about 7? In 2022, the Fed, a Federal Reserve, is going to raise interest rates 7 times. Just this month, they raised rates again. So the first increase was 25 basis points, 0.25%. No big deal. The second increase was 0.5%. 0.5%. So now 0.75%, they have raised interest rates. And what is the effect of that? Well, if you've got a line of credit, you see the effect. The price and the cost of you borrowing money from that line of credit has now gone up. There you go. So now it costs more money to use your lines of credit. How about car loans? Yep, those went up too. How about mortgages? Yep, you used to be able to get a mortgage. Heck, I mean, in the peak of the pandemic, just a year ago, in a peak of the pandemic, we could get a 30-year mortgage for under 3%. Last year, you could get a mortgage for 3 to 3.5%, give or take. Awesome. How much are they now? Well, let's just talk about after they raised interest rates 0.25%, a mortgage rate went up to over 5.5%. And that was only a 0.25% increase. Oh, you're wondering why it's not dollar for dollar, percent for percent? Yeah, that's interesting, isn't it? They just raised them 0.5% recently, which sent the markets tumbling. The day that they did that, it was anticipated that they were going to raise interest rates 0.25% . So the market rallied. The next day, the market fell 1,100 points and it continued to fall right up until today, which is one of the first up days that we've had. Maybe there was one other one in the middle, but it was short-lived. Well, 0.5% interest rate makes money more expensive to use. Money for cars, money for houses, money for boats, money for planes, money for margin accounts in your stock brokerage. That's right. Everything is getting more expensive. And the reason the Fed is raising rates 7 times is they want to slow your demand down. They want to slow you down from buying so much shit. That's why they're doing it. But in doing that, you're going to start halting the economy and bringing it down and slowing it down to curb inflation. Will that result in a recession? Probably not by itself. All that will do is slow things down, bring us back down to a normal inflationary period, which that's their hope, but they're probably not going to get there because there's some things that they're missing. They acted too late, definitely acted way too late. So there's definitely going to be inflation, into the foreseeable future. But that inflation is going to give way to one of two things, probably stagflation and then definitely deflation, which we'll cover in a second. But so the first thing that the Fed did, trifecta number one, or part number one of the trifecta would be the way to say that, is they're raising interest rates 7 times, making it more expensive for you to buy things, making it more expensive for everyone to use all that easy money that they printed and ran through their central banks. Number 2 of the Fed trifecta. If you were paying attention, the Fed announced back the end of last year that they were going to unwind the balance sheet. So any of you that understand what a balance sheet is, it's assets, liabilities, and your equity. So on the Fed's balance sheet, when they print money and they trade the money for debt, those debts sit on the balance sheet as an asset. It's a liability to the U.S. government because they owe the money to the Fed, and to the Fed, it's an asset. As of right now, May of 2022, the Fed, as they announced, has roughly about $8.9 trillion of U.S. treasuries and mortgage-backed securities on their balance sheet. They have been buying these bonds from the U.S. government since 2008, and it has blossomed the balance sheet to a whopping $8.9 trillion. Now, the trillion word gets thrown around all over the place, and a million is the new billion. I just want to be clear. Like, we all hear trillion thrown around, but do we all understand how much money $1 trillion is? None of you listening to this podcast could ever spend anywhere close to $1 trillion in your lifetime, or probably 20 to 100 lifetimes. You could never do it. But they have $8.9 trillion. And let me put that into retrospect in a different way. If you took the top 5 nations, China, Japan, Luxembourg, Ireland, I'm missing a couple, Ireland, and there's one other one, China, Japan, Luxembourg, Ireland. Sorry, I'm missing one in there. If you added all of them up, all of them, they're not even half of what the Fed has on its balance sheet. Not even half. That's how much money the Fed holds on their balance sheet. And they announced they're going to unwind it. So what does that mean? They're going to start selling the bonds off into the open market. That's right. They're going to sell some of that $8.9 trillion, and they're going to let those bonds mature, and they're going to sell them into the open markets. So what does that mean? Well, when you sell something, somebody else has to buy it. So when you sell it in the open markets, Wall Street, if you will, or you mature it, that means it sucks money directly out. Now, just for a second, let's pivot. All of you probably saw the movie Spaceballs. So close your eyes and just imagine that movie, Spaceballs. Remember the part where Helmet and his bad guys roll their big black ship up to that planet, which was clearly Earth, but they called it something else. And then their spaceship converted into a maid with a vacuum cleaner. Do you remember that scene? And then a portal opens, or the ozone layer opens to Earth, or whatever they called it. And they hook the vacuum cleaner up. And what do? They suck all the air out. The trees are getting sucked out. All the air is getting sucked out. People are unable to breathe. Now, let's go back to the Fed unwinding their balance sheet. The Fed has announced that they are going to start selling $95 billion a month. The first one's going to be like $47.5 billion for a couple of months, and then they're going to move it to $95 billion. So remember that vacuum cleaner and that ship that turned into the vacuum cleaner? That's the Fed. So instead of helmet, now that's the Fed. Earth, what is that? Wall Street, capital markets. They flip the on switch on, it starts sucking money, not air, out of Wall Street. Okay. When they do that, that takes liquidity away. That takes all this easy money that they just printed away, to the tune, if they did that for a year, of about $1 trillion. So they printed 5.1 trillion in a short period during the pandemic, and they're now going to suck out 1 trillion a year or more. They have the ability to change that until they get what they say is a desired result in slow inflation down. That right there, I want you to pay attention to the second thing that we're talking about, which is the unwinding of the balance sheet, which is the vacuum cleaner that sucks all the money back out of the capital markets. This right here has happened before. How many times? Roughly 7 times in history. Now, the Fed was created in 1913. Again, read The Creature from Jekyll Island, or another book called Secrets of the Federal Reserve. You'll understand this. 1913, the Fed was created. So since then, the Fed has done this a few times. Now, let me give you the ability to ask or answer a question. If the Fed has done this 7 other times, how many times when the Fed has done this has it resulted in a recession? What's your answer? They did it 7 times. How many times out of 7 did it result in a recession? So different answers are going to come in. Some of you are thinking, oh, maybe 1. Some of you put a lot of faith in the U.S. government and the administration. Like, I don't know, maybe 2. How about try 6? The Fed has unwound the balance sheet 7 times. And out of the 7 times the Fed has done this, it has resulted in a deep recession 6 of the 7 times. And also, let me add something. The Fed has never in history unwound the balance sheet or sold bonds to the tune of $95 billion. Yellen, the last time she did this, she did it to the tune of about $45 billion a month, and they only did it for a short period of time, which maybe they'll only do it for a short period of time this time. The Fed last week, this is hilarious, announced that they think they're going to pull off a soft landing, which means the 2 that I just told you, the increasing of interest rates 7 times and the unwinding of the balance sheet, $95 billion a month, those 2 things, they think that they're going to be able to pull off a soft landing, which is where everything slows down gradually and it doesn't result in a deep recession. So if any of you out there are into statistics or just math in general, what is the probability of that happening? If you ask me, 0. But if you ran the statistics and you said 7 times, it's resulted in a recession, all but 1, well, all right, what is your percentage? But they've never done it to the tune of this nature. A week ago, they said they're going to pull it off. But then just today alone, they announced that they don't think or they can't guarantee a soft landing. In other words, we can't guarantee a soft landing. What are they saying? No, we're not going to nail it. We're not going to get a soft landing. We're going to destroy the economy and the walls in the markets. That's what's going to happen. And why did they say that? Well, the markets have been shedding off tons of points, and the market's been tailwinding straight down. Some of the FANG stocks, which are the tech stocks, Facebook, Apple, Amazon, Google, Netflix, that makes up the FANG stocks, have shed off 63%, maybe even more now. Netflix and Apple's been down and Amazon's missing. Every one of those companies has been shedding off. So if you own stocks in tech companies, you're hurting right now. But even if you own the S&P 500 as of not today, but as of yesterday, you would have been down, I think, 13 or 14% year to date. And the Fed hasn't even got warmed up yet. They haven't even stepped up to the plate to swing. They raised rates twice. They haven't even begun to sell off the balance sheet yet. That doesn't start till June. And we're already seeing the markets shut off. How far down can it go? Well, it depends on who you ask and depends on what you want to believe. I think you're going to see at the end of the day an 80% shut off. Yeah, that's right. That seems like you're like, there's no way that's possible. You bet your butt it's possible. Look at history. Follow the charts. The charts tell all. Can the market lose 80% of its value? Absolutely. And will they? If the Fed does what they say they're going to do? Yep. Probability of success is probably close to zero. And that is only two of the three trifectas. The other trifecta, the third of the Fed's trifecta, already happened, but nobody paid attention. See, during the pandemic, during 2008, and any time when we enter these hard times, these recessionary periods, which we almost landed in a recession during the pandemic, we were definitely in a recession back in 2008. We were in a recession back in the early 2000s for the dot-com crash. Many of you probably don't even remember that. I do. That sucked. It's a 3-year recession. The Great Recession was a little over a year, but it was a severe recession. It was almost a complete collapse of the financial markets. The pandemic resulted in a 38% drop in the indexes in a very short period of time, less than a month. But then it bounced and everybody was like, oh, I'm making so much money, it's going to the moon. Well, the moon just disappeared, folks. It isn't going to the moon. It's actually going the other direction. So what's the opposite of the moon? Well, you can figure that out because we ain't going to the moon, folks. We're going the other direction. And it probably to the tune of 80% over time. How much time? Well, nobody can time the market. But let's just probably say end of 2023 is where we'll see like probably the major impacts of this. But the third thing that the Fed did is they stopped injecting new money into the capital markets. And they did this back in March. In March, they had basically stopped all their bond buyback programs, which is the act of the Fed buying bonds. And many of the bonds that they would buy would be from the open market. So when the Fed buys, remember, the Fed has the unlimited ability to not print, but control how many dollars are printed, the flow of money. They have the unlimited ability to literally print as much as they want. So they can print as much as they want, as many dollars as they want. And when they print the money, what do? They just then buy bonds in the markets. What does that do for the markets? Injects a whole bunch of liquidity. And who benefits from that? You, me, Wall Street, everybody. The wealthy benefit the most. It makes easy money. They stopped buying bonds in March, and they were buying a lot, billions a month. They stopped buying them. Now they're going to start selling them. So when they buy, it puts liquidity in. When they sell, it sucks liquidity out. So the trifecta is simple. Raise interest rates 7 times. That should do a good job of curbing inflation. You know why they're raising interest rates 7 times? You think it's because they want to stop inflation? That's what they tell you. It's because, and here's my theory, it's because they need to get interest rates higher because they know that this event's coming. They know they're not going to get a soft landing. They know they're going to crash the market. So therefore, they got to drop the lever and drop interest rates close to zero to try to prevent another deep recession, which they're not going to be able to do because interest rates are still historically low. So the best way to get interest rates up is, well, increase them 7 times and blame it on inflation, which they created anyway. And then let's escalate this. Let's make this go faster. Let's sell off a whole bunch of the bonds on our balance sheet and take liquidity out of the market. So the markets don't have new money. The markets don't have the same liquidity because the Fed controls it all. And the third, let's stop buying bonds and let's stop putting new money in the thing. The trifecta is what will bring the house down. And still don't believe me? Look up the inverted yield curve. I'm not going to go deep into this. Just look it up. The inverted yield curve is when you get paid more interest to buy a short-term bond than you get paid to buy a long-term bond. But buying a long-term bond contains, and depending on how you look at it, involves more risk because your money is being used for a longer period of time, maybe a 30-year bond. Well, just recently, the yield curves, the 2 and the 10 and the 5 and the 30, so that's 2 years and 10 years, and then 5 years and 30 years, inverted, meaning you got paid more to own a 5-year bond than you got paid to own a 30-year bond. And then it meant you got paid more to own a 2-year treasury than you got paid to own a 10-year treasury. This has also happened in history. I don't remember exactly how many times, but let's just 7 or 8. And every time the yield curve, which has been deemed as one of the most accurate predictors of a recession coming, is the inverted yield curve. And this already happened, just so you know, this already happened this year, not long ago, about a month ago it happened. And it basically tells Wall Street and investors that, hey, the yield curve inverted, a recession is imminent. And it's happened in past. And every time it's happened, it has resulted in a deep recession all but one time. Just like the Fed's balance sheet unwinding. You think the two are tied? I think so. Folks, these are the 3 things the Federal Reserve is doing. Now, let me ask you a question. What are you going to do about it? You're going to bury your head in the sand and pretend that nothing's happening? Oh, I'm not smart enough to understand this stuff. This doesn't affect me. The hell it doesn't affect you. Oh, it's going to affect you. It's going to affect your family. It's going to affect your kids' kids. Get your head out of the sand. I'm not even going to say it. Stand up and take responsibility for what's happening now. Stand up and understand that the cavalry is not coming to save your ass. No one is. It's time for you to be a good steward of your money. It's time for you to take action. It's time for you to understand that no one cares about your money more than you. So do something. So what do I do? What do I do? I don't know what to do. Well, how much money you got in that 401k? You still investing in the stock market? You still putting money in there? Change how you're investing. Put your money in safe assets. Put your money in things that are going to actually go up when this whole thing goes down, like treasury bonds. That's right. It's a great place to put money temporarily until it falls, because treasury bonds you can buy cheap right now, because as interest rates go up, the price of bonds goes down. When interest rates go down after the recession kicks in and we start seeing the market shut off, the Fed will drop interest rates, the price of the bonds go up. Isn't that how you make money? Buy low, sell high? Well, yeah, if you buy low, sell high, as Warren Buffett says, you don't lose money. Step number 1. What else can I do? Well, are you buying risky assets? Are you buying into assets to try to beat inflation right now? Are you trying to hedge or beat inflation by taking on more risk by buying risky assets like crypto or stocks or ETFs, or how about real estate? All of those that I just said will go down. So if you're buying them now, you're buying high. And I bet you any money when they all go down, you'll sell low. And guess what I'll do? I'll buy them. I'll buy them pennies on the dollar. Because if you're buying at the high point, guess what I'm doing? I'm selling at the high point. I'm selling my real estate, okay? Because I'm making major gains. I'm moving my money the same way the banks do and making small little spreads along the way very conservatively, but I'm investing in things I know, like, and understand that have very low risk or have a tangible asset that secures the investment. Is that how you're investing? Nope. You're putting money in the stock market. You're putting money in crypto. Where's the security there? Where's the collateral there? Oh, there isn't any. Right. I knew that. Start investing in things you know, like, and understand. Start changing your focus to be on protecting your wealth, not growing your wealth. Protect by investing in things that have collateral, by investing with people that have wisdom through knowledge, through time, and through failure. If you're going to invest with somebody in their project, make sure that they're wise. Make sure they've got wisdom. Make sure that wisdom comes from time doing that thing that you're going to invest in them to do. Make sure that that time that they've put in is somewhere along the path resulted in failure, because if it has, they have wisdom. Folks, the other thing you should do is subscribe to my YouTube channel. That's right. At the Chris Naugle. I put videos up every single week teaching you how to do this. I just wanted to explain what's happening right now. And I also tried to paint a picture of what's next. And what's next doesn't look so good if you're not ready. But if you are ready, if you do take some action, if you do pull your head out of the sand, stand up, raise the torch up and say, follow me, I'll show you through the darkness. If you do that and you prepare for this and you get ready for this event, the storm, which many of you call a recession or maybe even the next Great Depression, this storm will become your playground, will become the biggest opportunity of your life. Are you ready? Are you the one? Are you the one that's going to lead your family through this, or are you not? Time to make some decisions. Time to take some of this knowledge and put action to it. Now, maybe this isn't enough to get you where you need to be because you just don't have enough knowledge. Great. I already told you. I put videos up step by step what to do on YouTube. Take action, folks. I hope you all enjoyed this episode of the Money School podcast. And I hope that you take action. Remember, grab my books. Go to chrisnaugle.com. You can have the books for free. Just pay the shipping and handling, or just get the ebooks. And also join me every single week for the Wealth Webinar. There's a free webinar that we put on every week talking about topics like this. Whatever's relevant for the time, we talk about it and we give you actionable steps. To sign up for the webinar, just go to chrisnaugle.com and register for the webinar. It's free. Now, I've given you a lot of free value. It's time for you to go out and take action. Thank you for joining me for this episode. We'll see you on the next one.